Okay, let's go ahead and get started. I'm Debbie Liu. I'm the Associate Director of ESIG. Welcome, everyone. This is a special webinar. For those of you who aren't familiar with ESIG, we're a membership-based nonprofit organization. We provide members with objective information, resources, networking opportunities to support clean energy and energy systems integration decisions. And we do this through workshops, through tutorials, through webinars like this, blogs, we have working groups, and we have task force activities, and we produce technical resource materials. ESIG also serves in a leadership role with the Global Power System Transformation Consortium, or GPST, which convenes key actors to catalyze a rapid clean energy transition at unprecedented scope and speed. ESIG leads one of the 5 pillars of GPST, which deals with the research agenda for system operators. And if you're interested in more information on GPST, you can go to www.globalpst.org. Now, some logistics for today's webinar. All the participant lines are going to be muted. If you have a question, please go to slido.com and enter in event code ESIG12, ESIG 12. The instructions are at the bottom of the screen here. You'll see a thumbs up button next to questions, and that will allow you to cast a vote, and that will help prioritize the questions submitted. So we can't ask questions through the WebEx here. If you have a question, please go to slido.com. We're going to save time, about 20 minutes at the end of the presentation, to answer the questions on Slido, and an email with a link will be provided once the video file has been posted. So we're going to provide short responses to unanswered questions after the webinar. So please don't be afraid to ask questions through slido.com. So today's topic, multi-value transmission planning for a decarbonized future, is really hot today, especially with the FERC NOPR on regional transmission planning. That's at the top of everyone's mind these days. I imagine a lot of you are wading your way through 400 pages of the NOPR and preparing comments. A key component of the NOPR, of course, addresses the many benefits of transmission and also discusses ways that each benefit could be addressed. Here at ESIG, we established a transmission benefits valuation task force about a year ago. And this task force has been developing methodologies to quantify many of these benefits in detail. And Derek Stenclik and Ryan Deyoe of Telos Energy are going to be presenting the culmination of this work over the last year. So this task force developed approaches to evaluate different benefits of transmission beyond simply examining adjusted production cost benefits. So they look at things like risk mitigation and uncertainty, resource adequacy, and resilience among the benefits that Telos has been able to quantify in this project. And then they've applied the methodology to 2 sample transmission projects in Texas. With that, just a short reminder again, go to slido.com, use the event code of ESIG12 to ask your questions. I'm going to turn it over to Derek and Ryan. Derek is a founding partner of Telos Energy, which is an analytics and consulting firm that specializes in renewable integration, system planning, and grid modeling. Prior to founding Telos, Derek was at GE Energy Consulting, and he has a master's degree in applied economics and management from Cornell and a bachelor's from the State University of New York. And Ryan is a power markets analyst at Telos Energy and has experience in fundamental power market modeling. And prior to joining Telos, he worked for PA Consulting in their energy and utilities practice, and he led their ERCOT modeling effort. So with that, I'm going to turn it over to Derek and Ryan.
Thank you, Debbie. Really appreciate the intro, and thank you everyone else for joining today. We're really looking forward to sharing this work. As Debbie said, it's kind of very timely with the FERC NOPR coming out, and culmination here of a lot of good work, not just by Ryan and I and the Telos folks, but also the broader ESIG task force. So like Debbie said, we brought together a group of what I would call industry experts that we were able to lean on and really be a part of. So definitely want to make sure to give them credit where credit is due. So, and kind of in that vein, one of the first things we did as a task force was actually reached out to experts across the transmission planning space and really tried to identify where is transmission planning breaking down? Why are we having trouble building transmission? Why are we having trouble getting transmission through the rate making process and the system planning process? And these interviews, while we got a range of different inputs, 4 common themes kept coming up over and over and over again. The first was transmission planning today really focuses on local reliability. So think generator interconnections and kind of incremental upgrades to the network that we have, and doesn't look as much at regional economic efficiency. And that leaves a lot of value on the table. So that's going to be the focus of today's presentation. But there's 3 other barriers that we discuss and talk about in the presentation and the report. The second is around interconnection queues favoring short-term network upgrades rather than proactive planning. So in most ISOs, most RTOs today, we have an interconnection process that looks very serially at, okay, this class year we need to look at upgrades, and then we'll do the same on the next class year. And we don't have this renewable energy zone type planning where we look out and say, where do we want to build transmission? Where is this needed? And can we go out, build the transmission with the expectation that new projects will come? The third is around a lack of interregional planning and interstate coordination. So we have ISOs, RTOs, utilities, they are good at doing the transmission planning in their footprint. There's improvements that can be done, but there's a process in place. But then a lot of value when we think about transmission is not just within a footprint, but it's connecting these utilities, these ISOs, these RTOs together and getting a broader exchange of energy across the network. That just, for institutional reasons, doesn't get done as much today as it should. And then the last one, probably what we won't touch on, but very relevant in the FERC NOPR, is cost allocation is really hard. It's controversial, it's political, it's based on communities, there's winners, there's losers, and it gets tricky. Even if you have a perfect transmission system that makes a lot of sense economically, it can be tough to figure out who pays for that. But this is important. These barriers we really need to figure out as an industry how to solve, because at the end of the day, the transition to a high renewables grid really means at its foundation is transmission, and we need to come up with ways of planning transmission in a better way. So quick recap of where we are today and where we think we need to go. Today's approach looks at transmission projects for the most part solely on production cost saving. That's kind of the de facto metric of measuring whether or not a transmission asset is valuable. And as we integrate more wind and solar, production costs on the system inherently go down, eroding the transmission benefits if that's how we're calculating them. And yet the need is increasing as we bring on more and more wind and solar. So zero marginal cost resources coming in, production costs go down. And if we're only using production costs to value transmission, we're leaving value on the table. Another thing is, because of that, really only 10% of transmission is built based on economic planning. The vast majority is kind of local reliability based. And what this is doing is exposing customers to long-term costs. And oftentimes we focus on near-term benefits, and yet we don't look a little bit more holistically out in the future and understand that uncertainty and the risks that our system is in. And I think as a result of that, we're exposing customers to potential long-term costs that don't get quantified. So where do we think this needs to go? The first is around a multi-value benefit approach that incorporates risk, resource adequacy, and resilience. Those are kind of the 3 R's that we think aren't being picked up on in today's planning framework. The second is really understanding that transmission isn't just about saving a few dollars here and there. It's really an insurance policy to future uncertainty. It's an enabler for a lot of other things on the system. And then lastly, we need to look at a system that invests in enabling infrastructure like transmission rather than one that looks at solving reliability challenges just on the capacity side of the equation, which a lot of that investment could become future stranded assets in the future. So the framework we proposed in this project and in the white paper that will be coming out very shortly is really a multi-benefit approach to valuing transmission. And we specifically looked at 6 benefits that we'll be touching on throughout this presentation: production cost savings, renewable enablement, emissions benefits, risk mitigation, resource adequacy, and resilience. And we identified those as the 6 core benefits that need to be evaluated. And this is done in a few places. It's not done in others. And what we tried to do, there's been a lot of discussion on this. And if you look at the FERC NOPR, it's embedded in that as well. What we try to do in this project is simplify that message and come up with these core buckets. And we use ERCOT as a case study for that. And so we'll be talking a lot about ERCOT, a lot about transmission planning in Texas, but we tried to make this holistic. It's really about the methodology. It's something that we wanted to develop a playbook that can be applied everywhere. And so just to give you an idea of what we're trying to do here, we're looking at how we can stack benefits up to really capture the full benefit picture that transmission brings. And what we've seen time and time again is if you look at a broad range of these benefits, you see that a transmission project that maybe is close to break even becomes extremely economic, and it's kind of a no-brainer once you look at a wider range of these benefits. And then lastly, I'll kind of touch on the FERC NOPR. I know this is front and center in everybody's mind. There's several key topics that came out of the FERC NOPR on regional transmission planning. I listed a few that are really relevant to this study around scenario requirements, longer time horizons, coordination with that interconnection queue and portfolio planning approach, and a lot of work around interregional coordination. But I highlighted the multi-benefit approach that is discussed considerably in that FERC NOPR. And I went through and I identified 12 multi-benefits that were proposed in the FERC NOPR. I bolded the ones that we're going to be talking about today. There's other ones that we either chose not to quantify or just didn't have the tools readily available to do so. So I think this links in well, and ideally we're using this as a methodology, as a playbook to start implementing some of the discussion in the FERC NOPR. So with that, I'm going to hand it over to Ryan, who's going to talk a little bit more about the ERCOT case study and talk about the modeling approach and why we chose that. So with that, Ryan, I'll pass it over to you.
All right, thanks, Derek. Thanks for joining us today, everybody. So to give you the framing of why we're looking at ERCOT, really comes down to 2 points. One, it's an islanded system, fairly isolated, its own interconnection. And the second point is it has some of the most costly transmission constraints in the country to this day. So many of you might be familiar with the West Texas generic transmission constraint, which essentially locks renewable generation behind this transmission constraint, and it can't serve load in the east of Texas. As well as ERCOT has a lot of wind and solar potential. So in the framing of a decarbonized future, we want to enable those resources. So starting off, we built ERCOT, the ERCOT system, for a model to give us the baseline of how the system actually is today and what production costs look like. So we started with the ERCOT 2020 long-term system assessment, which we then built out to 2030 to show, as time goes on, as more renewables are added to the system, how does the production cost change? How does the West Texas export congestion change? So here we see a flow duration curve on the left, which is the West Texas export interface. So this is showing over time from 2023, 2026 to 2030, that as more renewables are entering the system and as load is growing and more load is being served by renewables, the congestion is actually increasing on the line. Now, from 23 to 2030, because more renewables are entering the system, there is an increase in the export limit. But what we're showing here is that that's not enough to alleviate congestion. Congestion grows from 14% to 55% by 2030, which is pretty significant and would hinder further renewable development, decarbonization goals, and also add additional costs to the system because you have all this zero marginal cost resource locked behind this constraint that isn't actually servicing your load. So your more expensive resources are running closer to the load, which is uneconomic. Additionally, you can see at the bottom the curtailment numbers in that chart. We're going from 3% curtailment in 2023 to almost 30% by 2030, which would significantly hinder developers' interest in building out for more renewables. Now, to address this, we looked to a recent special study done by ERCOT for specifically the long-term West Texas export special study, which looked at a similar question that we're answering here. Now, they framed it in the production costs methodology, and we aren't trying to replace their work here. We're just trying to be additive to it and show that, looking at production costs is really beneficial. There are things to be gained there, but there's more we can look, a broader view to apply and show that these projects are overwhelmingly beneficial. So using their proposed two options here, which option one is 4 AC lines that would expand transmission from west to east, and option two, which is 3 AC lines and 1 HVDC line going from west to east. What's notable here is that both of these are going to relieve congestion on the West Texas export interface. In fact, both of them by 2030 will increase the export limit by roughly 4 gigawatts, which is pretty significant. Now, the difference here with option two is that it's going to directly connect West Texas with Houston, which is one of the load pockets, as well as suffers its own transmission import constraints. So in the result, we actually see benefit for relieving the West Texas export through these upgrades, as well as benefits on downstream congestion, which is important for future planning purposes as well. For framing of what these projects cost, we used ERCOT's estimates on mileage of the lines, and then we used existing transmission trackers for ERCOT's 345 kV lines to come up with a total cost for the system, as well as we then used MISO's HVDC cost estimates for their transmission cost estimation guide to get a cost for the HVDC line. So that these come out to roughly $300 and $500 million per year of costs that need to be made up in the actual production cost savings. So moving on to what the production costs look like, we're actually showing that in 2023 and 2026, kind of to the point that we were making before, that production cost savings alone aren't enough to justify new transmission, important transmission, depending on what kind of goals you're trying to meet. They fall well short of the $300 and $500 million in 23 and 26. It isn't until 2030 that option one, which is the 4 AC lines, is slightly cheaper cost as well, actually breaks even. But option two still remains uneconomic. So the key takeaways that we have here from just looking at things at a production cost, in a production cost lens, is that long-term planning horizons are needed for long-term investments. You have to look further out, even further out than what we looked here. And the FERC NOPR suggests somewhere around like a 20-year timeline. Also, production cost benefits alone, they don't justify new transmission, but when you're, like Derek mentioned, when you're looking at increased renewables on the system, you're squeezing that production cost down lower, you're going to see less value from the traditional lens of transmission planning. So we want to take this one step further. We want to look at those range of benefits that we outlined previously. So I'm going to start just quickly talk you through the emissions benefits. Now, there is no federal policy on CO2 emissions. There's no state policies specifically for Texas either. However, we wanted to frame the emissions as current existing emissions risk, as well as potential future uncertainty around a carbon tax if that were being implemented, or just some people embedding the social cost of carbon in their calculations. So when you look at options 1 and 2 relative to the base case, there's a substantial amount of CO2 benefit using what we used was the EIA's CO2 price forecast, 3 scenarios, which was $15, $25, and $35 per metric ton, just as a framing here. The price is less important as what the methodology shows, which is that what you're doing is you're bringing zero emissions fuel resources from West Texas to ERCOT's load centers, which provides for substantial CO2 reduction benefits, which has a value, as well as some more modest but still important emissions benefits related to SOx and NOx, which are both regulated by the EPA. They both have markets, as well as Texas in the Houston zone has its own NOx market, NOx regulations. So these are harmful pollutants that we do want to reduce, and transmission can enable that. One thing that's really interesting to note here is that option 2, which connects West Texas directly to Houston with that HVDC line, has a fairly substantial benefit on reducing the costs associated with Texas NOx emissions in the Houston zone. So that's one of the differentiators between the two projects. And you can see that if you were to stack those up, you would have different outcomes in terms of what's valuable there. Moving on to our next benefit, which is the renewable enablements benefit. Now, what we want to try and do here was frame it as how do we capture the capital cost benefits of accessing lower cost resources. This to differentiate this from production costs. This isn't obviously wind and solar have zero production costs. So what we're trying to show is if you're trying to get X gigawatts and produce 1,000 gigawatt hours of solar or wind energy, how much is it going to cost you? And it's highly dependent on where you place it, right? Some regions are going to have lower land costs, they're going to have lower population, which makes it easier to site and develop things, as well as we're just talking purely about resource potential. West Texas has some of the greatest wind and solar potential in the country, and a lot of that's locked behind this West Texas export constraint. So the way we phrased this was we used LCOE data at a county level, and we considered that as transmission congestion would increase over time, some of the renewables cited in the long-term system assessment in West Texas would shift east, right? So we have 1/3 shifting by 2026, 2/3 shifting by 2030, because it's just uneconomic to build your resources out there. However, if your goal is to still have the same amount of potential energy that you're going to generate from the wind and solar resources, you have to build more capacity in the lower potential areas, and you have to pay more, and that's represented by the different LCOE. So on the left-hand side, you have wind, pretty substantial difference from $48 a megawatt hour to $33 a megawatt hour, being between building in west versus east, and solar a slightly smaller difference, but still significant when it comes down to how much capacity you're building. So by taking that shifted capacity, we then multiplied that megawatt or that gigawatt amount by the LCOE difference here, and we got a $180 million benefit just about in 2026 and almost $500 million benefit in 2030. So this is just strictly the capital cost, how much less money needs to be spent to get the same amount of renewable potential. The one little point we have here, Derek kind of touched on cost allocation, which we didn't address specifically, but an interesting point is here, who gets this benefit, right? That's something for, not myself to figure out. That's beyond my pay grade, I'd say. But, these are, by looking at more values, we have to understand who is benefiting that. Is that the developer? Is that the corporate getting a better PPA? Is that people getting access to lower cost resources? It's kind of societal benefit just as well as a grid benefit. Going to move on to the next benefit here, which we looked at as the risk mitigation and uncertainty. And we framed this as transmission may be a no regrets investment when you look across the range of futures. A lot of planning practices, people are familiar with developing scenarios, with developing, here's XYZ portfolio, here's a couple of gas price levels, here's my load forecast, and you can play around with those metrics. What we wanted to do was take that a step further. We developed 3 renewable and retirement levels, and then a baseline was everything was based on previously. All the other benefits were using the baseline renewables, but we amplified the renewable deployment, increased how many thermal units we're retiring, and then we decreased in the other opposite way. We decreased renewable deployment and delayed thermal retirements, right? Just to get a broad range of what potential futures could look like. Then on the actual uncertainty and risk side of here is what we created probability distributions for gas prices and load levels. Pretty cognizant of the time that we're having right now with gas prices reaching $7-8 per MMBTU. Like the gas price range that we tried to target here was between $1.50, $2 per MMBTU historical. Let's say you have another boom, you have excess supply, lower demand, prices crash, or you have supply constraint, which we're seeing today where prices are really high. And we wanted to frame this and show what does the transmission bring to the table if you have these types of volatile characteristics at play? I want to just pause here for a second and describe this graph with the 3 different lines in a little bit more detail, because I find it really interesting. When you're going from left to right, you have sample number 0 to 40. Each one of those dots has the same combination of load and gas. So let's say, on the high end there, at the upper part of the green line, you have almost $8 gas, right? But it's across a range of different renewable deployments and different load levels, right? So these have the same combination going from left to right, and you see that the value of the transmission is highly dependent on the gas prices. This isn't really a surprise when you consider that, if you're having more transmission constraints, more congestion rather, and less renewables reaching the load centers, you're going to be burning more gas. You're going to be more exposed to that financial risk that the volatility in commodity prices poses the traditional system. So you want to be able to capture the full benefit and say, well, hey, I have all these renewable resources, I have all these stranded resources behind this constraint. In a future where I need to rely on those more or I would want to rely on those more, it's actually not available unless I build this transmission. So that's the benefit that we're showing here, is that you're better able to weather these types of uncertainties, which I think is really prevalent today. I believe I accidentally zoomed in. All right, there we go. So I'm going to throw this back to Derek, and he's going to touch on the resource adequacy side of this analysis.
Thanks, Ryan. So most of what Ryan spoke about thus far was work done in kind of the production cost realm, looking at 8760 chronological dispatch. What we went to look at further is resource adequacy analysis, where we wanted to take that same chronological 8760 dispatch analysis, but really expand it across a wide range of weather years, as well as outage draws, and look at things more probabilistically and look at things in a resource adequacy lens to see, well, what is the capacity contribution that new transmission brings? And can we look at benefits from transmission, not just as a way from transferring energy from one area to another, but as a way to either reducing the amount of thermal capacity or firm capacity we have on the system, or kind of deferring new builds in that space. And so the approach we took is we evaluated 40 weather years. So for each weather year, we had a unique load profile based on historical weather observations. This was provided by ERCOT. And we had 40 years of plant-specific production data for wind and solar generators across ERCOT. And again, this is provided through ERCOT via UL analysis. And so when we combine that together, we take each of those 40 weather years, again, 8760 chronological evaluation of the system, and we run each of those across 10 outage draws of random outages across the thermal fleet, and we're able to come up with our loss of load expectation and other resource adequacy metrics. And so that's the approach. The reason this is important, it's a way that we can monetize the capacity contribution that the transmission is bringing by looking at the avoided capital cost for new generation. And so to show the results, we looked at, again, the base case without transmission expansion, option 1 and option 2, with either the 4 AC line or the 3 AC line plus the DC to Houston. And one of the reasons we really wanted to look at that scenario or that configuration with the DC line directly into Houston was to understand if we could get more energy directly to the load center in Houston, does that help alleviate resource adequacy events, and does that have more capacity contribution? And actually, when we first did this, we didn't find the results that we were anticipating at first. Essentially, there was no resource adequacy contribution to this this configuration that we were looking at. And really, the reason for that, we'll get into in the next slide a little bit more, is basically we have transmission that's accessing these renewable energy zones. There's already a lot of wind and solar there. And when the existing transmission is binding, when we need more transmission, is by definition times when we have too much wind and solar on the system. And so it's a way to transfer more of that. Now, when you think of resource adequacy, we're concerned about shortfall events when we don't have enough resources. And so typically when the transmission is binding out of West Texas is a time when there's a lot of surplus generation on the system. And so we didn't see a resource adequacy benefit in that example. And this is one of the reasons why the second half of this presentation, we'll be talking about interregional transmission, where we can actually access not only renewables, but also load diversity, geographic diversity, weather diversity on the system. And so this is just an illustration of what I just communicated, that when there are resource adequacy shortfalls in Texas under the scenario, the high renewable scenario that we looked at, it was times when there was actually a low wind and solar output. And so this chart shows a scatter plot of line flows across on the y-axis, the West Texas export. So this is flow out of West Texas into the rest of ERCOT. And then on the x-axis, Houston imports. So this is flow going from those regions into Houston. And you can see where the constraints are binding is the upper right-hand quadrant of this chart. So it's when West Texas flows are high, and then imports going into Houston are also high. And that's when our transmission congestion is hitting, and that's when we're limited. If you look at the flows during the loss of load events, though, it's periods when the flows are well below their technical limits and actually even reversing into West Texas. So this is times when wind and solar is dropping off and we're actually reversing flow into West Texas. So, you know, just looking at this chart, more transmission out of West Texas doesn't necessarily help. But again, we wanted to prove the methodology, and we'll get into some alternative outcomes in the next set, this presentation, when we talk about interregional transmission benefits. And so to wrap the West Texas example up, this is kind of this value stacking chart we were talking about in the beginning. And so you have on the far left of this chart, production cost savings, and you can see it's barely break even in option one, not quite break even in option two. But then when you stack out these other benefits, you really see the total benefits outweigh the investment cost. And so you can see in the West Texas export example, the renewable enablement benefits, being able to access those lower cost renewables in West Texas is a large contribution to the overall benefit stack, as is risk mitigation. So under a variety of different fuel prices, loads, and renewable deployment levels, you can see that there's additional contribution there. And again, going back to this idea of transmission as an insurance policy, we can't predict the future perfectly, and it's a key way to enable the future system regardless of what that future looks like. And with that, we're going to flip it back over to Ryan, who's going to talk about our interregional case study. And this one we chose really to look at to really highlight those resource adequacy and resilience benefits. So with that, I'll flip it over to Ryan.
Thanks, Derek. Yeah, so to reiterate that, we're going to focus on some renewable enablement benefits here, the resource adequacy benefits, and the resilience benefits of this interregional transmission line. So we specifically looked at a hypothetical line between ERCOT and Southern Company, specifically connecting ERCOT North to Southern Company's territory with a 2 gigawatt HVDC line. And, you know, for Southern Company, we modeled Mississippi, Alabama, and Georgia Power, modeled their footprints and their generators. To get a sense for the benefit that the line actually provides, we modeled ERCOT and Southern Company as independent systems, and then we also combined them to assess their production costs, the resource adequacy, resilience modeling. So we did look at some of the other benefits that we were talking about with the West Texas example, but we're just going to highlight the most interesting and the most important ones here that really drive the value of the interregional transmission line. So first, touching on interregional renewable enablement. So what we're taking that same question and we're switching it up. We're phrasing it as, you know, what are the capital cost benefits of trading Southern solar for Texas wind, right? So Southern Company, these entities, they want to procure cheaper renewables, and they have this transmission line they can use to then procure capacity in West Texas. So we decided to take a simple approach, which was looking at 2 gigawatt transmission line. We are assuming 2 gigawatts of contracted wind capacity at a 43% capacity factor. And that gave us 7,500 gigawatt hours per year of energy that, we're getting from the West Texas wind that we want to, replace and see how much it costs to build using Southern solar, right? And so the LCOE differential between building Southern solar and Texas wind is where we get where we get our renewable enablement benefit, which the delta is about $10 per megawatt hour. So about $75 million per year for accessing that those renewable resources in Texas versus building them in the Southern. And one caveat here is we did not assess additional production cost benefits attributed to renewables with a different diurnal profile. They're cited in different areas of the country. That is something that could be interesting. We just did not look at that for this study. Moving on to the interregional resource adequacy benefits, and this is where things get really interesting, where we take two unreliable systems, we link them together with this transmission line, and in short, we create two reliable systems. So initially, we built the Southern Company system, and there was limited LOLE in the way that we had it modeled, which was as the single Southern Company zone using the company-wide footprints. So we took that as a chance to retire additional coal and show that if Southern Company had a less reliable system with more of their thermal baseload retired, that they could then still connect with an HVDC line and receive significant resource adequacy benefits, enabling more retirements or delaying capacity expansion, since that's how we're phrasing the resource adequacy benefits as avoided capacity expansion cost. So this interregional transmission access really points out that there's load diversity and renewable resource diversity, as well as other generation diversity between ERCOT and Southern. And it enables both of them to be much more reliable together than they were without. So the way that we phrased it was that, or the way that we modeled it was, we took ERCOT as an island and Southern Company as an island, and we added 2 gigawatts of of combustion turbines in each to try and get us from the connected system reliability, from trying to get the isolated systems back to the same reliability that they were when they were connected. So what the chart shows down below is that in an isolated sense, both of them had an LOLE of about 0.34. And when you combine them, even with additional retirements in Southern Company, ERCOT has a 0.1 LOLE, which is, an industry standard, but it's not ERCOT's target number. ERCOT doesn't have a target number here. And Southern Company drops to a 0.01 LOLE, showing, very little resource adequacy risk there. So both of them become significantly more reliable. And we targeted these same numbers with backfilling the 2 gigawatts of combustion turbines, and we valued that at a net cone of around $60 per kilowatt year, based on ERCOT data, which gives us $240 million per year of avoided capital costs. So just to reiterate that, to get to the same reliability in each islanded system, without the transmission line, they would need to add $240 million per year worth of combustion turbines. Now, with the actual transmission line in place, they don't have to add those. So that is a benefit of the transmission line. Moving on to the resilience. So we're looking specifically at avoided costs of unserved energy during reliability events that exist in the system when the line is connected. So touching back on the previous slide, we ran both systems isolated and then connected them. So what we did to try and value this resilience benefit was we wanted to differentiate it from resource adequacy, right? So resource adequacy was framing that, we're reducing the number of events. We're reducing the probability of loss of load. We're going from 0.34 to 0.1. So there's just less events occurring. However, in that system of, let's say, 0.1 days per year, you still have events occurring, right? You still have load shedding. So we wanted to drill into that actual load shedding data and show, well, what does that look like in the system alone? What that same event happening in the unreliable system? And then when they're connected, what is that same date? What's that same sample number in our 400 sample run look like with the interregional line connected? And that differential between unserved energy is how we quantify the total resilience value. So we use the value of lost load for ERCOT and the value of lost load for Southern Company. And we looked at the reduction in unserved energy for each system, so ERCOT system specifically and Southern system, and then system-wide. And we use those vol numbers to quantify the value. So what we're seeing here in these graphs up above is that, on January 11th, you see an unserved energy event in ERCOT significantly reduced when you actually have the interregional transmission line. That's the orange there. The dark blue is ERCOT only. And then on the far right, you have an August 16th event in Southern Company with a significantly reduced unserved energy when the transmission line is actually in place. So there's a couple ways to frame this benefit. Obviously, we have the unserved energy, avoided unserved energy quantified, and we can get the total value of that. And taking that across all 400 samples, an annualized value of it is, system-wide $40 million per year. But I think the important thing to note here is that while that annual resilience value, 40 million, doesn't seem very high when you're considering some of the hundreds of millions of dollars of benefits that we've gone over today, each of these events that are occurring either in ERCOT or in Southern Company, they total up to $16 billion. And the average events occurring are like 400 million, 450 million between the two systems, right? So you're getting a $40 million annualized benefit, but in the event of one of these events occurring, you actually could be saving up, $900 million on average when you're considering events in both systems, or $450 million in either one. So that's a significant reduction in burden on both the grid, the ratepayers, on industry. So it's something that we think people should account for. And the annualized value here is important for doing that multi-value stacking. It's really easy to look at that and visualize it, but it's important to show what the total value is and what the average value is during an event. One thing we want to stress here is that we think this is an interesting way of looking at resilience, but it's not the whole picture. There are additional methods that are needed. We didn't look at specifically stress testing like the weather. We had embedded in our 40 years historical weather, but we didn't look at, let's create an extreme situation like Winter Storm Uri, or let's, create something that might happen like a hurricane, right? We didn't look specifically at that. And that's something that could show greater benefit and should be quantified, something we are advocating for moving forward. But we found that this way of framing was also beneficial in understanding additional value that transmission brings to the system. So bringing it all together, this is the multi-value stack for the Southern Company line. On the bottom of the box, you see the benefit cost ratio for production costs only is 0.14, which doesn't make it an economic project. It's only when you start adding the production cost savings, emissions benefits, renewable enablement, the resource adequacy, and the resilience that you get total benefits and a benefit cost ratio of 1.66. So the project is economic and it is beneficial. And again, I'd like to just highlight that, the resilience benefits that we showed here, $40 million annualized, it kind of understates that you might be actually insured against something more like $900 million or $1 billion event, right? So it's nice to stack them up like this, but there's more to the picture than solely this. And moving on past just the multi-value stack, Derek and I were gonna bring it all together and wrap this up, and look forward to any questions that you guys have. I don't know, I'll take this away, Derek.
Yeah, I'll probably do this one quickly because we touched on a lot of this. I think if I take a step back and think about the key findings of going through this process, was really, one, we talk a lot about stacking these benefits, but taking a step back and looking at three of them in particular: the risk mitigation, the resource adequacy, and the resilience. Not only does this add value to the projects, but it's also, looking at it differently, avoiding significant cost or risk exposure for ratepayers. And so while it shows that it makes sense on average, it's also mitigating these extremes, the Winter Storm Uri type event, or any extreme weather event, extreme macroeconomic uncertainty. So we really look at this not just as a way to stack incremental benefits, but transmission as a low regrets insurance policy. The second big takeaway is different transmission projects will have different benefits. It seems very obvious, but in the West Texas example, that's transmission projects that are really designed to access really low cost renewables and help reduce fuel costs on the system, emissions costs on the system. And in that example, didn't pan out on a resource adequacy and resilience play, and that kind of makes sense. We already have a lot of wind and solar in that region. Accessing more of it isn't necessarily going to improve that. And so really understanding that there's other transmission out there, like specifically interregional transmission, that's going to have paid dividends on the resource adequacy, the resilience, and other risk mitigation. So I think those are kind of broadly speaking the two that I wanted to highlight the most. You can read the other ones. I see one of the, kind of keeping track of the Slido that we'll jump to here as well, but one of the ones that's high on the list is, how do we communicate this in a less complex way so more people understand it and we can get action out of this. So I will say that, yeah, we ran through a lot on the modeling and the details here. And one of the reasons we chose to do that, and this was really important from the beginning of the study, was, if you just start talking about the reliability of transmission or these multiple benefits, it gets very hand wavy very quickly if you don't apply modeling rigor and you don't apply a methodology. And we thought, kind of after canvassing the literature and folks that have done a really good job communicating the multi-value approach and how transmission can enable reliability, we thought that there wasn't a clear way to actually show the framework and the methods and give system planners a playbook to go through and answer some of these tough questions. So, yes, this was technical, it was detailed. The report that is coming out very shortly, the first third of it, the first half of it, is really more thinking broadly and conceptualizing this and making it very understandable and digestible. And then it gets into the details that hopefully the transmission planner can go and implement. So yes, we're straddling that fine line of making something that's easy to communicate for the policymaker, the regulator, the layperson in the industry, versus somebody who's actually doing the transmission analysis at the ISO. And we're straddling that line, trying to target both with the work. Like I said, that report will be coming out very shortly. Nothing necessarily new from what was presented here, but we'll have a lot more detail, a lot more insight, and hopefully communicated in a clear way. And yeah, we'll have other ways of making that digestible, like blog posts and executive summaries and things like that. So with that, Ryan, feel free to join back on, and Debbie, you want to moderate maybe a Q&A?
Thank you so much, Derek. Thank you so much, Ryan. That was a great presentation. I just want to pull on that thread a little bit more of that one question and just ask, what do you want people to do as a result of this work? Like, what would you want, I don't know, RTOs or transmission owners or FERC or regulators, policymakers? What action would you want folks to take away from this to do?
Yeah, great question. So maybe three things. One is, and this is a takeaway we have in the report, it's kind of get comfortable with uncertainty. And I think as system planners, we always try to dial in a couple scenarios of what the future is going to look like, and we plan to that, but we're going to be wrong. And if anything in the last 2 years proved anything, we can't forecast out the next year, let alone the next 10 or 20 years. And I think we need to get comfortable with that in our planning framework and think a little bit more holistically and look at transmission as an insurance policy and make our planning processes much more probabilistic, stochastic, and capture that uncertainty. The second thing I would say to actually kind of start to think about and implement is really looking at, I guess, drawing on that reliability, resource adequacy, resilience thread further is, at the crux of it, that's the untapped benefit, I think, that we're not capturing in our planning processes today, is capturing those RA benefits, the resilience benefits. And so just making sure that that gets captured, it gets quantified, and it's not just hand wavy oh, by the way, this is going to help reliability. It's like, no, this could significantly change the reliability picture on the system. You know, in the ERCOT and Southern example, we took two systems that were, you know, above the resource adequacy threshold by a considerable margin. And without adding any new resources to the system, both became reliable. So you took two unreliable systems, connected them, and all of a sudden they're both reliable. That's like a big finding and something I think we should capture. And yeah, lastly, one more. It's escaping me now, but I'm sure I will come back to it. I don't know, Ryan, if you had anything else to add.
Yeah, I would just, maybe it's just in addition to what you already said, but looking beyond strictly reliability or, you know, like the local reliability upgrades, but really economic transmission planning, right? You know, I don't think people should, or grid planners should shy away from, you know, people have already done it, like Texas did their CREZ line, which accessed all of that wind, spur renewable development, and these types of things should be happening, right? It shouldn't be piecemeal. It should be large and, you know, transformative, that they know they can actually benefit a wider range of people, both ratepayers as well as the grid in general. So I think that economic view has a lot of value to add beyond just like the production cost savings.
And thank you, Ryan. That reminded me of my last point of actionable things we can do. I think just increasing the interregional coordination and planning. We're doing a lot of work within an ISO, within a utility footprint. Like, what's the best way we can optimize our system? And yeah, we're leaving a ton of untapped value literally on the sidelines. I think the FERC NOPR addresses that really well. It's going to be really hard to put that into institutional practice, but I think that's where the big value is. And I know ESIG had the macro grid project, which is a great step in that direction, but we just need more of that collaboration. ESIG's a really good opportunity to enable some of that cross RTO ISO collaboration.
Great, thanks. I'm going to turn over to Slido, and the top question is, can you elaborate on the models and software programs that you used?
Sure, that's an easy one. So we use Plexos for both the production cost simulations and the resource adequacy. So we took Plexos for the production cost, the 8760 dispatch, and then we took that same model, same data set, and then added stochastics to it, ran it through multiple weather years and multiple outage routes to calculate our loss of load metrics. So it was entirely kind of in the economic planning context, but I will say the ERCOT work, the West Texas Export Special Study that just came out recently, we leveraged a lot of really good power flow and stability simulations that were conducted. So when we looked at the configurations of how many AC lines, how many DC lines, and what that does to the limit, the foundation of that was PSSE, PSCAD type analysis that we relied on.
Thanks. And Omer Kara-Duman asks if you can speak a bit more about how your approach would fit into value stacking for interregional transmission lines, and can there be a case for merchant investment?
Yeah, I actually saw this question come in right before we flipped over to the interregional case study. So I think this was, you know, when we were looking at the West Texas. So hopefully we answered that. You know, I think the question is now, is that merchant or is it some other cost allocation mechanism? I think there are opportunities for merchant transmission, you know, interregional, but there's also ways to make that interregional transmission can be cost based to the ratepayer as well.
Right, and just to touch on that, like, you know, if you're not using the multi-value approach that we lay out here, or just, you know, looking at a broader range of benefits, you're not going to build the line unless you're looking at resource adequacy or resilience, things like that, right? You're not going to build it for just trying to save production costs in your internal system. So, you know, hopefully, yeah, we did answer that question for you, but.
And that brings up a good point. Like the interregional transmission, we looked at a system, there's no capacity market in the Southeast, there's no capacity market in ERCOT, yet there's huge RA benefits. And so for a merchant line to participate in that gets difficult, right? Because how you pay for that resource adequacy isn't clear on either side of the line. And then when you're looking at completely different market structures on either side of the line as well, it makes it even more complicated. So, yeah.
That's a really good point. Trying to have market structures that would help you take advantage of that are important. So we answered this question. Bev, for you, the presentation is going to be posted on the website, the sources, the links for different citations will be on the presentation. Let's see, how do you treat pancaking costs for a line going from ERCOT through other states to Southern Company? Do you include them in your avoided capacity cost valuation?
So we sidestepped that a little bit. We assumed the HVDC just from point A to point B, and while it passed through the MISO footprint or the entropy footprint, we didn't evaluate that. There are huge opportunities, especially where the projects that are being considered today, to tie in MISO South into this analysis, and there's just yet going to be more resource adequacy benefits the more you can do that resource sharing across different systems. So we didn't, but yes, folks could. Hopefully that have bigger models, bigger data sets, bigger computers to help do that.
Thanks, Derek. Marty Schwartz from NREL asks, how did you determine the firm capacity of the new transmission line? How'd you get to 4 gigawatts? Did you look at metrics like EFC or ELCC?
Yeah, so essentially what we did is an EFC type analysis where we just evaluated the change in loss of load expectation with the addition of the transmission line, and then we compared that against a scenario where we added 2 gigawatts of firm capability in both regions, and then we made the assumption that outage rates and things across the HVDC would be similar to like a conventional gas turbine.
Thanks. And Russ Philbrick asks, would a larger HVDC collector from West Texas to Houston avoid the need for other AC lines and show greater benefits? Or does this impact reliability too much?
Okay, so the question is, instead of doing 3 AC lines to North Texas plus 1 HVDC to Houston, can you just build a bigger HVDC to Houston? Yeah, worth evaluating. I think because if you look at ERCOT today, the West Texas export is the most expensive from a congestion rent basis, most expensive constraint. The next most expensive, I believe, still is the Houston import. That's why we modeled those 2 big interfaces. So presumably you can kill 2 birds with 1 stone. Certainly worth evaluating more. We found that HVDC was just very expensive relative to the AC lines at this point. If there's changes there, it's a really long, really expensive line with the HVDC. But yeah, worth more work there as well.
Yeah, and I'm not sure that the benefits would be like so much greater with the larger HVDC, because you still have the Dallas-Fort Worth area in North Texas that you don't want to just send all the electricity to Houston, which has its own congestion interface, right? And they get stuck there. I mean, obviously they would use it, but there's benefits to the other parts of the state too, I think, for having the wider lens. But we just looked at some projects that ERCOT proposed as potentials, right? As to relieve that, just as to ground our basis in their analysis too.
Okay, thanks, Brian. Ken Kollick asks, why is the ERCOT area isolated? It'd be cheaper constructing interconnection lines between bordering areas rather than building long line substations, etc.
This one I think came in right before we switched over to the southeast connection as well. I think my answer is both. I think there's value to both the West Texas export and interregional, and I think those actually compound each other, because then it also allows neighboring regions like in the southeast to not only access the resource diversity benefit, but also get access to the West Texas lower price renewables that would get followed up.
Yes, very good point. And Dmitry Kostrov from BPA asks if you've looked at the value of energy storage to address resource adequacy issues in your studies.
Yes, is the short answer. So there's a lot of energy storage evaluated in this resource adequacy analysis, and I'll do a shameless plug to the other ESIG task force on resource adequacy work, and that captures that topic quite a bit.
And I notice we're getting up to the top of the hour. So I would like to thank Derek and Ryan so much for this path-breaking work on multi-value benefits from transmission. I mentioned earlier that an email is going to go out to all of you once we post the video file, and we'll answer the questions we didn't get to, get all that posted. The presentation will be posted. It'll have links. So you can go to our website probably in a few days for all of that. And we really appreciate your engagement. For those of you who are interested in transmission and the generator interconnection quagmire, we're soon going to be holding a webinar May 31st to talk about interconnection study criteria and those impacts on network upgrades and system planning. And we're holding our next workshop in Denver, June 6th to 9th, on forecasting and markets. And this time we're going to combine it with a grid forming inverter workshop. So workshops, monthly webinars, they're open to everyone. Feel free to register at esig.energy. And Derek and Ryan, thank you once again. Really timely, informative, and thanks to all the participants for the questions and the interest. And we look forward to seeing you again in the future. Thanks.
Thanks, everyone.